of the number of estate tax returns here. In fact, the estimate now is we will probably have no more than about 2,000 to 3,000 estates a year subject to the estate tax anymore. It is really narrow. Now, the bad news for those who are actually impacted, well, like all the strategies that you do for ultra high net worth planning remain relevant for clients that are over that threshold. But watch out, because the IRS is likely going to be heavily scrutinizing these and auditing almost all of them. Truly almost all of them. I mean, when there's only 2,000 or 3,000 a year, if you do the math, like that means there's only a couple dozen a week. So they've got a bunch of IRS agents here. They can look at virtually every single estate tax return that comes in to see if there's things they need to dig into further. So expect a lot of scrutiny on any estate tax returns that actually get filed. For most clients now, this is actually just going to be a state issue. There's still a little over a dozen states that have some level of state estate tax. Now they're going to have to figure out, do they recouple and go up to 11.2 million? Or frankly, do they just get rid of it? Right? When there's only 2,000 to 3,000 estate tax returns a year, if the states recouple back to the federal limit at $11.2 million, 2,000 or 3,000 estate tax returns a year. That means on average, there's only like 40 to 60 per state. So the average state would have like one estate tax return a week. At some point, when you're only taxing literally a couple dozen people in your entire state, at some point they're just going to move to a state that doesn't have an estate tax when there's only a few of them and the dollar amounts are that big. So there's a lot of discussion now about whether some states are just going to get rid of their estate tax because it's so narrow, it's not even worth them trying to pursue it because they're just going to drive away the few people that matter, which actually has an economic impact to the state anyways, because they lose the income tax revenue once the person leaves the state. Now, for the last portion of the presentation, I want to talk about the new big deduction that has showed up. The deduction for pass-through businesses, often called the Section 199A deduction, because that's the new Internal Revenue Code section that defines it. You may hear this called the pass-through business deduction. You may hear it called the QBI deduction, because it's technically called a deduction for qualified business income, or QBI. Now, this applies for any business that is not a C corporation. So it's been discussed as pass-through businesses like partnerships, LLCs, or S corps. Even sole proprietors get this, though. One of the first questions we started getting from clients who were like consultants, do I have to make a partnership or an LLC now so I've got a pass-through business in order to get the pass-through deduction? You do not need a business entity. Even sole proprietorship on Schedule C counts. As long as you are not a C corporation, you are eligible, or at least potentially eligible for this. And the deduction itself is pretty straightforward. It says take all your business income and subtract 20% of the income from the income, which means in essence you only pay 80% of the tax rate itself. So if the blue line here is the new tax rates under the system and the brackets that kick in, the orange line is what the rate would be after the QBI deduction. Essentially, the orange line is 80% of the blue line. So you end up with a top tax rate on pass-through business income of 29.6% at the top instead of 37%. That's the impact of the QBI deduction. Now, the deduction is limited. It can't actually be more than 20% of your total taxable income, and I'll show you an example in a few minutes of where that kicks in. The big thing, though, is while the QBI deduction is calculated based on your business income, it's claimed on your personal tax return, not from the business's tax return. So you'll find the IRS laws update the forms that this is literally going to come on your personal tax return. So what you're looking at here is page 2 of the tax return. So if you think like page 1 of the tax return, the front page of that 1040, that's where you add up all your income, the wages, the portfolio income. You take your so-called above the line deductions. You get to the bottom right hand of the front page of the tax return. That's your adjusted gross income. Then you turn to the top of page 2 and your AGI carries over. Then you start taking deductions. So first you take either your standard deduction, your itemized deductions. Then historically you would take your exemptions, but personal exemptions are gone now. So this is where the new QBI deduction will go. So it's a below the line deduction, but it's separate from your itemized deductions or standard deductions. So regardless of whether you take the standard or itemized, you still get this QBI deduction. And then from there, you'll calculate your taxable income and figure out what your tax bill is. Now, there are 2 limits to the pass-through business deductions, the QBI deduction, what's called the specified service business test and the wage or property test. And these tests kick in once you reach the new 32% tax bracket, which is $157,500 for individuals, $315 for married couples. And then once you hit it, you phase out over the next $50,000 to $100,000 of income. So two different tests here that you need to be